Good morning, friends. We have finished cash flow statement, and today we will start with business combination and consolidations. So today, our topic of discussion is business combinations and consolidations. Now, when I talk about business combination, so basically it includes mergers as well as acquisition, right? So when I talk about this combination, it is merger and acquisition. Now in case of merger, what happens? There are two companies, Xco and Yco. They merge and form a new company. So after this merger, a new identity will come into picture, that is merger, right? Xco was operating separately, Yco was operating separately, decided to integrate their business activity, they decided to come together, right? That is merger. Now in case of acquisition, like this is Xco and this is Yco, right? Both are separate entities, right? With respect to Xco and Yco, both are what? Separate entities. They both are separate entities, but the parent company among these, I'll tell you who is a parent company, right? So both, suppose this is the acquirer and this is acquiree. Here what is happening? One new legal entity is getting formed. This is merger. In case of merger, Xco was operating separately, Yco was operating separately. They integrated their business activity. They decided to come together. They have formed a new company, that is merged company. So after this merger, Xco will not be in existence, right? What will happen? After merger, Xco and Yco will cease to exist. After merger, Xco and Yco will cease to exist, right? Now when I talk about this acquisition, it means one company is acquiring shares of another, right? Like X and Co has acquired 50% plus shares of Yco. So first of all, both are separate entities, right? They are not integrating their business activities. Like I have invested my money in your business. So first of all, I will be called as parent company and this person will be called as subsidiary company. Right? So now what will happen in case of acquisition, right? Now there are few acquisitions which I have covered in investment when it is less than 20 and it is 50 to 20. Now here I am talking about more than 50. So what will happen? Xco will prepare standalone financial statements. Yco will also prepare standalone financial statement. And Xco has one added responsibility of consolidated financial statement. So Exco will prepare two financial statements. One is alone separate and one along with subsidiary. So this is Exco along with YCO. This is Exco along with YCO. Is it fine? So in case of merger, what is happening? I'm integrating my business activity. I'm deciding to come together with another company. So the old company will not be in existence anymore. The new legal entity is getting formed here, right? New legal entity is formed. New legal entity is formed. Right? In case of acquisition, what is happening? I am acquiring shares of another company. So if I am acquiring 15% shares, so you know fair value through net income. If I am acquiring say 20 to 50% share, then in that case what I will do? Equity method. Now when it is more than 50%, right? So in that case, Exco preparing its own financials, YCO also preparing its own financials. They are preparing their respective standalone financial statements, but they need to go for one consolidated financial statement also. And the responsibility is on Exco, the parent company. The parent company will consolidate its financials with its subsidiaries. Right? And when I talk about this consolidation, one thing you have to remember, economic entity concept. So we have fair value through net income 0 to 20, 20 to 50 we have equity method, more than 50 we have consolidation under economic entity concept. Right? This is purchase method. Right? Okay. So when it is acquisition, when I talk about acquisition, right, no significant influence, that is below 20%. So what do you follow? Fair value through net income, right? When you have significant influence, that is 20 to 50, so we follow equity method, right? What do you follow? We follow equity method, isn't it? Plus 50%. Parent subsidiary, right? What do you follow? economic entity concept. Basically, the point here is parent is having control over subsidiary, right? Parent is having control over subsidiary. Like investor is having control over investee, acquirer is having control over acquiree, right? When members of parent company constitute a majority of the board of directors of subsidiary company. Member of parent company constitute a majority of the board of directors of subsidiary company. Right? Now, if it is more than 50%, when I have control over the investee company, I need to consolidate. Now, this consolidation will not be done on my books. Neither it will be done on subsidiaries books. This consolidation will be performed in a worksheet, right? Like it's a separate requirement for making the. If I am the parent company, it means my own financials are there. It means it is my responsibility to consolidation on a worksheet. It means I will be preparing two financial statements. One is my own. In my own, it will be showing investment in subsidiary. But when I consolidate, in that it will show my assets, his assets. Like this, right? So we'll explain you all the process, no problem. But I think this is okay. Next. Suppose I have acquired shares here. Shares acquired. So this is investment in subsidiary company, right? It is plus 50%, right? So on this date I have acquired. This is year end. This is second year end. Now this is in whose books? This is in parents' books. Subsidiary will have no effect. When I am acquiring your more than 50% shares, subsidiary will not have any effect. Why? Because anyone can become the shareholder of subsidiary. When subsidiary has issued shares, anyone can get the share. There is no such accounting, like if someone is holding your majority share, then you have to do. For subsidiary, it's a normal share issue entry. Or shares might have been purchased from stock exchange, stock market. In subsidiaries books, when I talk about subsidiaries book, it is common stock and additional paid in capital, liability, equity section. Under equity section, it is issued shares issued for subsidiary. Now anyone can become the shareholder of this common stock. If I am your shareholder holding 1 shares, he is another shareholder holding 10 shares, he is another shareholder. So subsidiary doesn't pass entry like that. Subsidiary does accounting as a whole. This much total number shares I have issued. Up to par value it will go to common stock. Excess of par value will go to additional paid in capital. So for subsidiary it is very simple. These shares are already issued. So whether I am purchasing subsidiaries more than 50% share directly from subsidiary or indirectly through stock market, it doesn't matter. What matters is who has control, that person will do accounting accordingly, depending upon my percentage of holding. For subsidiary it is common stock. Now for parent company what it is? Investment in subsidiary. If this investment would have been less than 20%, then I know how to do accounting. Right? If it is below 20, what I will do? I will do investment debit, cash credit, this is first entry. Now when I receive dividend, I will straight away take to income statement, cash debit, dividend received straight away income statement, right? Number 3, for changes in fair value, what do you do? If fair value is increasing, we do investment debit and we take it to income statement, right? This is below 20. Now when it is 20 to 50, we go by equity method, right? So this is normal. Investment debit cash. Now under equity method what we do? Proportionate share income of investee. Whatever profit investee has earned, proportionate share I will record. So what do? I do investment debit, equity in earnings credit, right? Don't we do this? Now when you receive dividend, what do? You reduce the value of investment. Remember? And there is one more entry which we do. That is write-off, goodwill impairment, excess of fair value over book value. Remember? For write-off what we do? We reduce our equity in earnings debit and reduce investment. So this is what equity method is all about. And here changes in fair value is not accounted for. So when it is below 20, we know how to do accounting. When it is 20 to 50, I know how to do accounting. Right? When it is plus 50. So we are learning consolidation. We are learning consolidation. Is it okay? So this we will learn. This is consolidation. I agree this is consolidation, but what about when I purchase share? It means When I have acquired shares, that point what entry I will do? So from this period to this period, this investment will be accounted for as if cost method and equity method. Consolidation is at year end in worksheet. So throughout the year, from the date I purchase share till year end, it is cost or equity method? So these entries will copy. It is either this one or this one. So remember, this consolidation is at year end, and that too this is in worksheet, not affecting anyone's book. It will not affect anyone's books, right? This consolidation is in worksheet. It will not affect holdings book. It will not affect subsidiaries book. Parent is also known as holding, right? So throughout the year, its accounting will be like equity method or cost method. So it will not affect parents' books and subsidiaries book. It will not affect. Next. During the year, it is cost and equity method. So this cost and equity method will have no relevance when we do consolidation, because this is there in parent's individual standalone financial statement. Year end, once we do consolidation, again when I do next year accounting, I will again go by this cost and equity method. Again next year it will be what? Cost and equity method. Again consolidation in worksheet at year end. Consolidation in worksheet. Tell me one thing, if there was no requirement of consolidation for investment in equity shares, we will follow some or the other method? Yes or no? Suppose there was no requirement of consolidation, because anyway we are not doing consolidation in parent's book. We are not doing consolidation. See, subsidiary has got no idea what's going on. Subsidiary has got no idea what's going on because it is none of his business. Anyone can be my shareholder. And according to significant influence, they will do accounting, not me. I have already done accounting when I issued shares. So it is the investor's treatment which is important, not the investee. So in short, I can say when it is 0 to 20, if suppose there was no mandatory requirement of consolidation, right? 0 to less than 20, we will follow fair value through net income. Basically, this is cost method only, except entry number 3, right? If it is 20 to 50, we will follow equity method. We follow what? Equity method. Even if it is plus 50, still we follow equity or cost method. We got year end balance. This year end balance is there in parents' books. This investment belongs to the parent, right? Now after year end, the consolidation will be done, that too in a separate books, not in parent, not in subsidiary. It's a worksheet, right? So this particular consolidation is in separate worksheet. Is it fine? Is it okay? Now, why it is economic entity concept? What does the economic entity concept mean? When consolidation begins, right? Year end may we will do consolidation in worksheet, right? When consolidation begins, it will be assumed as if the acquirer and acquiree, as if the acquirer and the acquiree are single economic entity, right? Now, acquisition date, either shares are acquired from market. So when it is acquired from market, it will be investment in subsidiary co cash credit, right? Simple. Yes or no? This is acquisition date, and or shares are purchased from subsidiary co right? If it is purchased from subsidiary co, or the subsidiary has issued shares, then in that case it will be investment in subsidiary co debit, common stock credit, additional paid in capital credit, right? Now this consideration which I am paying for acquiring the shares is at the rate fair value, right? See, I can purchase from market, right? For me it is investment. So when I am acquiring shares, from market or company directly, whatever, here I have purchased shares from subsidiary by issuing my stock. I have purchased by issuing my stock. Right? So instead of cash paid out, I am issuing shares. Instead of cash paid out, I am issuing shares. So this particular accounting we will do when we acquire shares on acquisition date. Clear? Now, what about during the year? Here we will talk about accounting during the year. So we can either go for cost method. Yes or no? Here, value of investment does not change with income of subsidiary or dividend received. It is simply investment to cash and dividend is directly taken to income statement. So there is no change in investment value. Right? Under equity method, what do you do? Value of investment change with income of subsidiary को or dividend received. Just I showed you. So acquisition date, I have already got my investment in my books. One is by issuing cash or your debentures, whatever. And another is by issuing common stock. So this is acquisition date accounting. This is during the year accounting. Consolidation on worksheet. Consolidation not in parents' books. This is whose accounting? This is parents' accounting. This is whose accounting? Parent company accounting. Acquisition date during the year. Consolidation in whose books? Neither subsidiary nor parent on a worksheet. Is it okay? Okay. So now, when I do consolidation, right, there will be one journal entry which I have to pass, because there are a lot of common items that needs elimination. Like investment in my books, consolidating or eliminating journal entry on worksheet, right? Repeated times I am telling you, this is parent company. Parent company has its own common stock, additional paid in capital, bond payable, current liability, tangible asset, intangible asset, investment in subsidiary co, then current asset, right? Then subsidiary company will also prepare its balance sheet, right? These are tangible assets, intangible assets, current asset. Subsidiary will not have any investments. Subsidiary will not have any investments, right? Now there are so many common items that we have to eliminate, like this investment in subsidiary which you are seeing in parents books. This is nothing other than shares issued by subsidiary. Right? Whatever investment I have, that is shares issued by subsidiary. Sometimes what is happening? When I am purchasing shares, of subsidiary, I can also use my common stock. I can issue further common stock, so that will increase my common stock. See, this investment I can get by using my cash. Number one. This investment I can get by issuing my own shares. So either I will purchase subsidiary share by giving cash, or I will purchase subsidiary share by issuing my stock. Right? Whatever shares I have purchased, that is already in issued category. That is already in issued category. So this particular investment represents shareholder fund of subsidiary company. So when I am consolidating these two on a worksheet, don't you think that these two will be eliminated? Right? See this entry. See, investment in subsidiary debit, investment in subsidiary debit. Either I am using up my cash or I am issuing common stock. To whoever I have issued this common stock, that person will show as investment in its books. What I have to do with that? Let me change this. When shares are purchased in subsidiary, by issuing common stock of parent. So either I am using up my cash or I am issuing my stock. Anyway, I have investment in my books. So either it will reduce my resources or I will increase. Now from whoever I have purchased, that person will show as an investment in his books. The shares which I have issued, I have got nothing to do with this. Right? It can be cross holding also. When the cross holding will come into picture? When these shares in subsidiary I have purchased from subsidiary directly by issuing my shares. So I will also have investment in parent here. There might be a case that I purchase these shares in subsidiary by issuing shares. So I purchase these shares from subsidiary directly by giving my shares. Right? See, I have issued shares, right? I have issued shares. So it will be in my issued category. Either I will issue share or I will use up cash. Whoever has subscribed for these shares, has given subsidiary shares to me. Then only there is an exchange. Na? So in their books, this investment will come. For them it is investment. If these shares are purchased directly from subsidiary by giving my own stock, the subsidiary will also have investment in parent company. Maybe 10%, 20%. So this is cross holding. So we are not talking about here cross holding right now. Right? We won't be talking right now about cross holding. Right? Suppose these shares were issued to Ambani, Reliance or Tata. They liquidated it in the market and I grabbed it from the market. So either I will use up my cash or I will issue my stock. For subsidiary, what is the effect? No effect. Anyone can acquire his shares from the market. How can I stop? But when I do consolidation in a worksheet, don't you think this investment and this common stock issued are common? This is eliminating. This represents this only. This particular investment in subsidiary is what? Equity of subsidiary. So this will be eliminated. Right? So this consolidating or eliminating journal entry will be like this. Common stock. Right? 100% of subsidiary will be debit. Additional paid in capital, 100% of subsidiary is debit. Retained earning, 100% of subsidiary is debit. Right? Then investment in subsidiary को credit. This is my investment in your company. So this particular investment will represent equity of your company. So when I am consolidating, when I am adding all the assets, all the liabilities, so don't you think this and this are common? So I have to eliminate. So this I have credited and this I have debited. The equity section of subsidiary is debited. The investment section of parent is credited. The investment section of parent is credited. Cancelling of investment debit, so credit. This is credit, so debit. Now don't you think there is a difference between the carrying value and the consideration? We have done in equity method also. So when whatever price we pay for our investment, right, we do up to book value, then excess of fair value over book value, then consideration minus fair value will be goodwill. Yes or no? So what you do? You do excess of fair value over book value. This is also about 100% of subsidiary debit. Yes or no? Huh? Now, suppose I have acquired only 80% shares. I have acquired only 80%. It means if I see the shareholder register, list of shareholder of subsidiary, 80% name is parent company, 20% is others. Now what has happened? I have eliminated here 100%, but this is 80%. So remaining 20% is what? Non-controlling interest. Though it is not under my control, my ownership, but still, since I have the majority, so whatever I will say, it will happen. This is not my shares, so I have to show it as a liability. Right? This is non-controlling interest. So this is percentage acquired and this is percentage non-controlling interest. Difference will be goodwill debit. So we have, you can write goodwill here also, no problem. This is also again 100% of subsidiary. This is full consolidation. Right? So what I will do, equity section of subsidiary will be eliminated, investment of parent will be eliminated. As a result, 20% is not yours, but it is under your control. BV number 1, Salman Khan, Karishma Kapoor, 51%, 49%. In that movie, it has shown. Even if Salman Khan had 49%, but entire control was with Karishma Kapoor. Same thing here. I have 80% shares. 20% is with others. So that 20% I have to show as non-controlling interest. And these two is excess of book value over fair value, and this is goodwill. Excess of fair value over consideration. Sorry, excess of consideration over fair value. Right? When you practice more and more, you will automatically get this. No problem with this. Right? So as a result of this consolidation, what will happen? All assets and liabilities will be added. Will be added line by line, yes or no? Common stock and additional paid in capital of parent will only come, because anyway subsidiary one is getting eliminated with this. So in consolidated financial statement, I will have equity portion of only parent, not subsidiary. Because subsidiary's equity portion is getting eliminated with investment in parent. Right? So this is getting eliminated with this. Simply add this. Rest all items will come. Like tangible asset of both, intangible of both, current asset of both, bond of both, current liability of both, but common stock and only of parent. Is it okay? right? I will tell you all these things in more detailed way, right? No need to worry about that. Let us do one example, right? So balance sheet total is matching. This is balance sheet as on 31st December year 1. Right? Now what we have to do, question 1. P company acquired 100% shares in ESCO for $900 in cash. Right? Is it okay? So what is the journal entry? And this journal entry is in P company books. Right? Parent company acquisition date. Investment in ESCO debit. Cash credit. Simple. Now you can see parent has sufficient current assets, no problem. Parent is having what? Sufficient current assets. Out of 3,000, I am assuming we have sufficient cash. And that cash has been used to pay off this. Now if someone tells me to prepare new balance sheet, PICO, ESCO, immediately after acquisition, current asset is 2,100. Non-current asset, no change. But here now I will get what? Investment in ESCO, how much? 900. This is like 400, 500 dash 11,900. Liability side, no change. As it is, it will copy. Clear? Is it fine? Now we have question 2. P company acquired Okay, let us do one thing. So this is what we have done immediately after. This is immediately after acquisition. Now, point is, year end I acquired. I acquired when? 31st December year 1. It means immediately after acquisition, this is done. This is their respective balance sheet. This is what their respective balance sheet. Now I will go for consolidation. For consolidation, they have given you some fair values because it is done in a worksheet and fair values are required, right? On the date of acquisition, as companies fair value of all assets and liabilities is equals to book value except one non-current asset whose fair value was in excess of book value by $100, right? Is it fine? So now we need to do one thing. We need to pass eliminating journal entry, right? What is the eliminating journal entry? Common stock 100% of subsidiary debit. How much? Common stock of subsidiary 100. Additional paid in capital 100% of subsidiary. Again 100. Retained earning 100% of subsidiary. How much? 400. So these three is what? Carrying value of equity. This is what? Carrying value, book value. This is what? Carrying value or book value of equity. Right? This is carrying value of equity. I can also call it as book value of subsidiaries equity, right? And equity is what? Asset minus liability. So I can also say that this is book value of subsidiaries net assets. Right? Now, investment in ESCO credit $900. So can you see the difference between book value and invest? This is consideration paid. So the book value is 600 and I have paid, the book value is 600 and I have paid 900 for that. See this? I acquired this from someone. What is the book value of this? Subsidiary has an asset of 900, current liability is 300. So what is net assets? Net asset is 600. It means whatever I have acquired, its worth is only 600. Yes or no? Its worth is only, but how much I have paid for it? I paid for it 900. So don't you think this 900 versus equity of subsidiary 300 difference? Out of this 300, excess of fair value over book value debit how much? 100. And we don't have NCI here because there is no non-controlling. When it is 100% stake, I will not talk about non-controlling, right? The difference will be what? How much? 200. Non-controlling interest is not there. No problem. So it means, how will I do it? Book value of equity is what? Book value of subsidiaries. Book value of equity is what? Book value of subsidiaries net asset. This is $600, right? Then we have fair value of subsidiaries net asset. That is $700. How? Excess of fair value over book value is 100, right? And Consideration paid is how much? 900. So this is excess of fair value over book value, and this is goodwill. So this is 200 and this is 100. Very simple. Is it okay? Now when I do consolidation, in a worksheet, I have to do consolidation in worksheet, right? So how will I do that? Very simple. Consolidation on worksheet. This is P co alone, this is S co, and this is consolidated financial statement, right? First, let me prepare individual. We have current asset 2100, non-current asset 8000, investment in subsidiary 900. This is $400, 500 dash 11,900. Then we have common current liability 2,300. We have equity, common stock Epic RE, common stock 1,000, 3,000, is it fine? Right? So we have already passed eliminating journal entry. We have already passed eliminating journal entry. We have already passed. Right? Now this is very simple. When I talk about consolidation, right? I can easily do it, no problem. See, it will be line by line addition of these. Right? It will be line by line addition of these items. Okay? Now when I do line by line addition, I have to be sure about fair values, because that excess also I have to record, na? What was the eliminating journal entry? This excess I have to account for, right? It will be added with non-current asset. So current asset there is no change. 2500. This is getting credited, so it is 0. Right? but goodwill will come 200. So don't you think we have to show excess of fair value over book value in respective item and goodwill? We should not forget these two when I am doing assets. Right? So this is how much? 11,300. This liability will be line by line addition. This will fully be not there. Only this portion. 1,000, 3,000, 5,000. So what you do? Line by line addition of assets and liabilities plus excess of fair value over book value plus goodwill. Done? Then parents equity will come. Done? Investment in subsidiary of parent and equity section of subsidiary. This is removed. And lastly, NCI will come. So this is the mool mantra of consolidation. If NCI is there, non-controlling interest, is it okay? So that's it from today. In the next session, we will continue, right? Thank you so much.